Hey, good afternoon. I'm going to do a quick update on the market. Things are not going the way they are supposed to go. Rates are almost at an all-time high. Well, not all-time high, but a high in the last, certainly in the last year, if not the last 5 to 10 years. So let's go through and see what is happening in the market. So typically we're going to see the mortgage rates get better as inflation comes down. Mortgage rates get worse as inflation goes up. So you've got mortgage rates as the blue line on this chart, and the red line is inflation. And you can kind of see that inflation was going down, mortgage rates were going down, and then mortgage rates stayed the same. Kind of for a very long period of time, we kind of traded flat, yet inflation was going up. If you see that red line there, increasing. What happened during that period of time is quantitative easing. The government was buying a lot of mortgage-backed securities, and they were artificially keeping mortgage rates low. Well, once the government stopped buying mortgage-backed securities, we saw interest rates start to go up in 2022, and we saw them increase all the way until October of 2022. And then they started to pull back, but they're just not pulling back the way they should. Inflation is taking a dip down. You can kind of see that top line has peaked. And we should be seeing rates closer to about the 6% range. Right now, we're right near 7%. So what is happening is we are getting a short squeeze, essentially, from small and regional banks. They have had their stock prices really depressed, and they're having tons of deposits leave. Well, if you're a small bank or a regional bank, you need deposits to lend out to make money. So the only way for them to raise capital, since their stock is down and their deposits are down, is they can sell some of their assets. They can't call your car loan due, they can't call your mortgage due, but they can sell some assets. Well, banks have been buying mortgage-backed securities and treasuries, and they have to sell those right now at a loss, which is putting negative pressure on the markets. When we look at the markets, this is a view of the we're going to go to the UMBS, which is the Universal Mortgage-Backed Security 30-year coupon that's trading at 5.5%. And we can see that we're at 99.53. On this chart, down means rates got worse. So May 10th, we were expecting some really good news from the CPI numbers, the Consumer Price Index, which has a lot to do with the housing cost and the cost of goods. And we did get some good news. We had a nice day in the market. You can see this big green candle. It did what we thought it would do, and it made rates better. The next day, the news started to turn because we started to get some conflicting data about the economy. And for mortgage rates, we want to see inflation coming down. We want to see the market cycle changing, and that's going to lead to unemployment. That's going to lead to less spending. And we're just seeing steady spending. We're seeing steady unemployment numbers. We're not seeing an increase in job losses week over week. It is taking people longer to get a job once they become unemployed. That number has been increasing, but the initial jobless claims has not been increasing as a lot have suggested it should. And we see this slide of rates coming down over the last 2 weeks, where we should have seen this May 10th number starting to make rates get better. But what that slide is it's the regional banks selling and putting pressure on the securities. Now, if we switch over to the 10-year, on this chart, up means rates are getting worse. So it works opposite of how the mortgage-backed securities are. And again, we can see that May 10th, this chart was going down. That means mortgage rates were getting better. And we had a lot of room to go where we didn't see the need to do some quick locks, but we didn't know that the pressure from the small banks was going to be so great. So if you look down here, you can see that this line, this is called the stochastic, and it is oversold. We have a lot of technical indicators that suggest we should see a quick reverse in the market. And we see this star pattern right here indicates that we should see a turn, but again, we have another green stick, which means things have not started to get better. So when we look at what's coming and going and where average rates are, a great website that I lead a lot of my clients to is Mortgage News Daily. It's going to have a current pulse on mortgage rates, and you can see that nationwide right now, 6.98 is an average rate with great credit. Oftentimes, that is going to be with some points charged to it. They call it best execution. But the media reports mortgage rates typically 5 to 10 days in the rears. They're always a little behind on the data that they use. So Mortgage News Daily is going to show you a little bit closer of a current environment for mortgage rates. So we're right around 7% as of the recording of this video. So in other market news, properties are selling. So this is the percentage of properties that sold in less than 1 month. And you can see throughout 2021 and 2022, up until we started to see inflation really peak in October, is when it really kind of got out of hand. And then we went into our normal slower season with the winter seasons, and it was taking houses longer to sell, but we are climbing. So houses selling in less than 30 days is over 70% right now. If you look at the number of properties selling above list price, this also had kind of bottomed out last spring. It was really, really a tremendous amount of houses that were selling over list price. 60% were selling over list price. It was hard to get a house under contract unless you were well over the asking price. But this kind of bottomed out in January, February, and we are seeing this increase again. Over 30% of homes right now are selling above ask price. And there's multiple bid on about 28 to 33% of the homes have multiple bids right now. So it is, again, hard to get a house under contract. The last thing we've got here is the median days on market. So again, we saw this peak up to about 35 days. And really a balanced market's about 4.5 months. A lot of places you'll see it say 6 months, but about 4.5 months is a true balanced market. So we are still in a seller's market. We just saw last year sellers freak out a little bit because the houses were selling in 15 days and that number started to increase. And so a lot of sellers who thought they would get a quick sale did not. So they started decreasing their sales price right away. But we're seeing this trend reverse now, and the average days on market is now back under 25%. So there's a really quick update. What's coming ahead? I do think June 13th, we will see CPI numbers come out again, and that could give us some good news in mortgage rates. The overall urging factor in the industry right now is the debt ceiling. That's causing some problems, and it's causing some mayhem in the markets. And then the regional banks needing access to money, and they are putting a hurt on the markets. We should be around 6% right now. We should be in a declining rate environment, and the rates have only been going up, and it's because of another factor that nobody could tell was coming. This is, I think for the last 3 years, every year we've had some factor that is outside of normal that throws all traditional logic out the window. But if you need some good advice, if you need to talk about strategy on locking or waiting, please give me a call, reach out to my team. We are here to help you, and I hope you have a great day. Thanks.